Welcome back to Markets with May. In this episode, we're going to talk about Twitter. Does Elon's offer make financial sense or not? So last Thursday, Elon Musk comes out with an all-cash offer of $54.20 per share to purchase the remainder of Twitter shares. Now, he's a very large shareholder, so you got to realize he already has skin in the game. Now, at first, I was like, it's probably okay, top of my head. But then I noticed that a lot of the press was coming out super aggressively. Some folks even suggesting that the stock at $50, where it traded to, was overvalued by $20-something, what have you. And
Our view is that the stock is overvalued by about $20.
I thought to myself, wait a second. I actually have some accounts where I'm long Twitter at the low 30s. Now, as you guys know, every quarter I personally listen to 400 calls and review the financial documents for at least 400 companies in the S&P 500. And my recollection was such that I just didn't understand why there was such significant negativity in a stock that was trading at 39 before Elon made the offer. Additionally, what most people that review the financial statements themselves know about Twitter is that the data feeds often have the information massively incorrect. It just has to do with all of the different things that Twitter does on taxation side, things that it's done on the deal side that make the financials not feed into the data feeds correctly. As such, this weekend, I went back through the 10K and reviewed a number of different things that I want to share with you so that you can make your decision on whether you think Twitter is undervalued, overvalued, and whether or not you think the deal is a fair deal. Now, I'm going to assess 3 different things, and then I'm going to make some final comments on just these types of transactions in general. The first thing we're going to talk about is cash flow and how precisely Twitter has a negative cash flow. And my suspicion is it's not the way that it's being spun in the press to the public. The second thing we're going to talk about is Twitter's valuation and what might be a reasonable metric and what might be the metrics that potentially someone on Elon's team might be looking at the company. And the third thing we're going to talk about is whether or not a private equity firm might be able to come up with the capital and the thought process to potentially make a counteroffer. Before we get into that, I just want to remind you, past performance is not indicative of future returns. Definitely consult a local professional who can review your financial statements in general and make sure that they meet your investment needs. Additionally, it would be amazing if you could like, share, comment below if this is a helpful video to you. And if you give me a subscribe, I would be so thrilled. Last thing I just mentioned is there is a paid version of Markets with May where I do live Q&A Monday through Friday. So that would be another way to get in touch with me if you are interested. Additionally, there are a bunch of other things that go along with the paid version. Now, let's get into Twitter. What's actually going on here in the financial statements? Now, one of the first things I want to talk about is this idea that Twitter has negative cash flow. And if you just look through the data feeds, it will show a negative cash flow. But I was thinking to myself as soon as I heard it, wait a second, I remember there were some things, there were quite a bit of notes when I looked through briefly on the quarterly statements and also listened to the call. So I went back through and I want to show you precisely what the cash flow statement looks like and what I'm seeing.
Now, it was really fascinating about a lot of the clips that I saw talking about cash flow is that while folks said Twitter was negative cash flow, it was unclear to me what they meant by that. If you'll notice on the cash flow statement, cash flow from operating activities is positive 632 million. You've got positive cash flow as well coming from investing activities. And then you have cash flow from financing activities being negative, but on some you have a positive cash situation coming through the cash flow statement. Now, I know some of you are thinking this could mean that they were using some sort of free cash flow metric, and I'm going to get to that later in the video. I'll show you something you really kind of need to take into consideration on the income statement if you're going to do that calculation. But it just doesn't totally make sense to me exactly why someone would say this firm has negative cash flow.
Now, if we're looking at the cash flow statement and we review and notice that cash flow from operations is actually positive, and we can see the depreciation expense and we can see the one-time impairment. So that's going to come in handy later for some of our other questions. Now, let's go over to cash flow from investing. And when we look at cash flow from investing, we see that that is positive. So there was positive cash flow from 2 parts of the cash flow statement. Now let's look at the one outstanding negative part of the cash flow statement, and that would be cash flow from financing. And when we look at cash flow from financing, we notice that you see some really interesting activity in financing. You see the issuance of a large convert, and then you see almost $1 billion worth of stock buyback. And when you do the math there, you realize that if they had not done the stock buyback, cash flow from financing also would have been positive. So that's a curiosity. I know some people will say, hey, May, you can't do it that way because fair and square, if they needed the financing, they needed the financing. So that's where I'm going to take you into a little journey over into the balance sheet. And when we look at the balance sheet, I want you to notice the cash balance.
So all we're doing is taking cash and cash equivalents plus short-term investments to get that cash number. And then we're essentially taking everything in debt that is not a current liability just to keep it simple. But in fairness, there might be slightly different ways that various people would do this.
So if we're going to net those two things out, you have about $6.3 billion in cash and short-term investments. If you then look at long-term debt, you get to something like $5.3 billion. So if you were to calculate enterprise value and use that instead of market cap as your metric, you would have to net these things out and you'd be subtracting from market cap to get an enterprise value. In other words, these financing activities did not necessarily have to be cash flow negative. It was probably because the stock is perceived as undervalued by management that they went ahead and bought back that much stock and instead funded themselves in a convert given low interest rate environment. In light of these aspects of the cash flow statement, I think that those that are very wildly negative about this deal because they feel that Twitter is massively cash flow negative, it's a little bit of an aggressive stance to take on whether or not Elon was insane to make such an offer. Now let's move on to valuation. Now, the correct and proper way to do this is to use a proper discounted cash flow. And additionally, you'd really have to investigate a bit further what Elon's specific strategy is for the company, other than he just doesn't believe that this management team is doing the right things to create value for shareholders. Instead, a relative value metric, and then use the multiples as a means to think about whether or not the valuation that was presented was awkward, strange, unreasonable, that sort of thing. You can't really use market cap because we are actually talking about a takeout bid, so we're going to use enterprise value, and you can do an enterprise value to sales calculation, which puts you slightly over 8 times sales. But potentially what you really are concerned with is more, what is the earnings of this company as current on what you're paying for? And in that regard, you can't quite use an earnings number because, as I mentioned, there's depreciation, there's things like that. But there's one other item that really makes me think that you are going to have to calculate more of an adjusted EBITDA number, and that is the R&D expense. I want to show you this R&D expense and how much higher it was this year. Now, this is actually what we also saw in other media companies because there is so much changing on the landscape of media. That said, if Elon is saying, I don't agree with the strategy you're taking, I don't believe it'll monetize the company in the future, you kind of have to take that out. Additionally, there are ways to fund R&D that don't necessarily hit the income statement in quite the same way. You can do collaborations, you can spin out those arms in a particular way and take an equity ownership such that it doesn't hit the income statement quite the same way. Now that's beyond the scope of this video, but certainly something that Elon and his team would have a lot of knowledge on how to do. So let's say I'm gonna calculate an adjusted EBITDA number, adding back in the R&D, adding back in depreciation. Also, this one-time impairment that came from last year has to be added back in. What then is my adjusted EBITDA number? And it gets you to about $1.4 billion. So now I take enterprise value and divide it by that adjusted EBITDA number, and I get about a valuation of 26.5 times. And I ask the question, is that good? Is that bad? Is that high? Is that low? Well, this is always the hardest question around. I mean, 26.5 times is higher than what a lot of people would traditionally consider a market multiple. But it really comes down to the idea of, did Twitter grow last year? And when we look at the revenue line, we can see very clearly that in fact, it had about a 36% growth rate year over year last year. So is this deal completely insane? You know, it's really hard to say. It kind of depends on what you would think future earnings might be, future revenue growth might be, and it all comes down to the strategy that is in Elon's head, which is always hard to predict from far away. Now let's talk briefly about private equity and whether a poison pill, all that stuff, how should I think about that? I mean, look, if someone tries to enact a poison pill on this, Folks have talked about the fact that Elon will probably sue as a shareholder, which is his right to do, that management is not working in the best interests of shareholders. And I think that he's probably got more than a fair shake to do that, given what we just saw in valuation and why he believes that the company maybe isn't doing the right things. It would be as simple as to just argue that R&D expense is not being used in a way that legitimately would take the company to the next level, and then presenting what he think actually would take the company to the next level to argue that. So now the other thing is, could a private equity company even justify these valuations? I just showed you what I showed you. You tell me. I mean, they're probably going to run a proper DCF. Maybe they have their own thought processes about what is possible with the assets of Twitter and where social media is going to move forward to. It's hard to say. I mean, I would say that Twitter is, when it comes down to it, not the biggest market cap out there. So it's not as if you couldn't eventually sell this to someone else if you fixed a few of the elements of Twitter. Now, the thing I find intriguing about the question of private equity and counterbids is that, yes, it is all about subscribers, it is all about daily active users, but thus far, people have primarily focused in on buyers within the media space. So they've really only thought about companies like Disney or Paramount and things like that. And I've really been shocked that it hasn't moved over into companies that might have a different sort of ambition. For example, we've got Microsoft and Activision still on the docket, and it seems to me what Microsoft is attempting to do is not only flesh out their gaming division, but bring in that massive and impressive headcount that is so knowledgeable about metaverse development, gaming technology, and that sort of thing. If we think in those terms, then both Google and Salesforce could be interesting candidates as well on the list. If you're someone like Google, maybe less so because you just make money in a very particular way, but it's not as if they don't have the cash to do a deal at $41 billion. On Salesforce side, interestingly enough, if they were trying to map directly to an office strategy like Microsoft, then realize that one of the things that sits in the middle of LinkedIn and has been something that Microsoft has highlighted and continued to improve upon is the LinkedIn message feed, along with the ability to give seminars on LinkedIn. And interestingly, that's kind of what Twitter has in the way of its IP. So Salesforce is also a company that could potentially be someone to watch on the M&A front. Now, I will say to all of that, my expertise is not M&A, nor is it banking, so it'll be anyone's guess what could happen. Now, as a last few couple of notes, this was a best and final offer. And in that regard, I do agree with Kramer, this idea that there might need to be a face-saving move that allows some negotiation from management so they at least look like they tried to do something as relates to the hostile. I, again, will reiterate that I think the poison pill is a very bad idea. The other thing I would mention is, what am I gonna do? I'm probably gonna hold on to the stock and just see what happens from here. I don't think it's worth $30, as some people like to suggest it was worth. And I do think that given what's happened in media, this was gonna be something that was gonna hold for multiple years anyways. I would also mention that Parag Agrawal is a new CEO for Twitter. He comes from the operations side, and he did what I would consider a average job on the last call for me. I know other people on the street might have felt a little differently, but for me, I didn't get enough strategy to be super excited. I didn't get a lack of strategy such that I was going to sell the stock outright. I was willing to give him a couple of quarters to see how the stock progressed and whether or not the strategy would be laid out more fully. But I can kind of appreciate where Elon's coming from as relates to the fact that he doesn't necessarily think this team has a plan that's going to take it into the next phases. Now, I would mention as well that I do agree with Elon and others that do see social media transforming significantly, and that this next wave of what technology and what catches on will be exceptionally profitable. So I can kind of appreciate where Elon's coming from if he has a strong view on what needs to happen in this area, both from a freedom of speech perspective, but also from a what catches on and what becomes the way that we communicate with each other. The metaverse thing is real. Whether or not someone can make it profitable is a big question. That where Twitter sits, given its user base and given some of the most recent things that have happened, it does have a shot to be the launch pad for something that could be really great in the metaverse. So if Elon has a very strong vision. I'd like to hear even more of it and exactly what his thoughts are to execute it. But it wouldn't put it past him that he wouldn't be able to tell the board why he felt that current management isn't going to do it. That's all I've got for this episode. If you want to comment below on what you think about the deal, that would be awesome. Like, share, and if you want to see what my latest is, definitely subscribe to my station. Until next time, good luck in these markets.